So, Mohamed El-Erian is the president of Queen's College at Cambridge University, advisor to both Allianz and Gramercy. Mohamed's with me now. What a lot happened in a month. But the core question remains the uncertainty that exists, whether or not we get a technical recession or not. The monetary medicine hasn't really started to take effect yet.
That's absolutely right. And welcome back, Richard. It's wonderful to have you back. Yes, I mean, we have this peculiar situation in which very high inflation is causing the Fed to aggressively hike interest rates into a slowing economy. And it's not just a slowing US economy. While you were away, we also had the IMF latest forecast, and they were labeled gloomy and more uncertain. You and I know that the IMF doesn't use the word gloomy very lightly.
So in this scenario, because everybody's focusing on the fact that job growth is still there, and one of the usual precursors or necessary conditions for recession is rising unemployment, or at least faltering job creation, do you think we are seeing a new paradigm?
I think we are seeing a paradigm of supply disruptions. And part of that supply disruptions is in the labor force. So we are not seeing, as you know, as high a labor force participation as we would expect. We still have 1.9 vacancies for each person unemployed in the US. So we are in a new paradigm of deficient supply. Part of it is being played out in the labor market. And of course, a much bigger part is being played out still today in supply chains.
The significance of the war in Ukraine at the moment, the ability of Russia. Now, I noticed when Russia reduced the supply of gas to Germany, prices rose, but Germany is becoming a lot more efficient and weaning itself off Russian gas. So as we go into winter, can you see that as being a less significant play?
Yes, to the extent that we are seeing high prices destroy demand. We're also seeing it for petrol or gasoline in the United States.
Right.
There's much less consumption. People are driving less. But having said that, if Russia were to cut completely gas tomorrow, Germany, unfortunately, would still fall into a big recession. Germany has reduced its dependency, but hasn't eliminated it.
The earnings season is underway. The numbers are better than perhaps we'd expected, not as good as some would hope. Now, as I just started, we said that we were not seeing the full thrust of monetary policy yet, but we're getting an idea of what the landscape looks like as we go into higher interest rates. And what for you is that earnings landscape?
So I think most companies are now finding a new phenomenon, but it varies from one to the other. For a long time, they were worried about their cost side, high costs, high inflation, and what to do in terms of do you pass it on to prices or not. Now, they're worried also about their revenue side. But when you go from the general statement to specifics, I can tell you that companies vary tremendously in terms of how robust that demand is. They vary tremendously in terms of the pricing power. So expect a lot more dispersion in company performance.
If you get that dispersion in performance, it's very difficult for investors to value what is good value. I mean, we're moving into this position. All right, so S&P or Dow or an individual company might be down 20, 30%. But it's very difficult to value whether that company is cheap or expensive, other than traditional EPS methods, if you're going into a recession.
It is, and that's why you've seen this inability of markets to come up with a theme and stick to it. They're still over-reliant on the Fed. You know, when you're away, Chair Powell had an unscripted remark in which he suggested that interest rates were neutral. The markets took off. 4% of the 10% you cited for the S&P in July came immediately following the Fed announcement. It was the biggest move in equities since the Fed announcements. And it just shows you how sensitive the markets still are to any macro indicator.
Where do you think we are? I mean, I was going to say the Fed has front-loaded its rate rises with the 2.75%. But that might not necessarily be a particular strategy. That might just be a reaction to the fact that that inflation is so high. Is it front loading for purpose, or is it front loading out of panic?
It's the latter. They're playing massive catch up. They have fallen so far behind the inflation dynamic that there's questions about their analysis, their forecasts, their communications, and their policy reactions. That's not good for the world's most important central bank.
Finally, how does this happen? How do we get to, all right, even with supply chain, even with Ukraine, how do we get to a situation where every major central bank has been so, and this is my word, not yours, has been so either cautious or negligent that they didn't spot inflation about to not just rear its head, but go on a gallop?
If you want to be charitable, you would say that the changes were all exogenous and unanticipated. Who would have anticipated the war in Ukraine? But inflation was a problem before the war in Ukraine. The US inflation rate for mid-February was already 7%. I think it's complacency. People got used to a certain macroeconomic regime of insufficient demand, and they didn't pay attention to the extent to which COVID has changed the underlying dynamics of the global economy. It was complacency.
We're going on to the next story, but before I go to the next story, I want your thoughts on it. China is warning it won't sit by idly. Nancy Pelosi, as you know, is expected to visit Taiwan. The relationship, if China decides to get aggressive, whether because of Pelosi or any other reason, is this an exogenous event that could make all the others pale into insignificance if China decides to go aggressively against the US or others because of Taiwan? How worried are you on the Taiwan question?
So I don't know what aggressive is, but if it is what I'm thinking you're thinking, and they really do go aggressive, that would be a major shock. It would fragment the global economy even more, and it would increase supply uncertainties and demand uncertainties.
Mohamed El-Erian, grateful to have you with us.